COVID-19, the global economy is at a standstill. Markets are in turmoil.
The S&P 500 opening lower by more than 8%. Of course, that greater than the 7% level that triggers the level 1 circuit breaker.
Retail sales down.
Oh my God, look at this. All right, retail sales year to date minus 20%.
Unemployment up.
4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
Good afternoon, everybody. I'm Alex Steele, Bloomberg anchor based in New York, or currently Brooklyn, my apartment. On behalf of all of us at Bloomberg, I'd like to welcome you to the U.S. portion of Day 2 of Invest Global. And I'd like to start by thanking Invesco Triple Q, our founding U.S. sponsor, for helping make possible this global event. And you can check out more about Invesco QQQ in the resource section of our event platform, so go ahead and do that. Before we bring the program, a few housekeeping notes for you guys. Make sure you're using Firefox or Chrome to view any of the sessions. If you are having any trouble with audio or video quality, just go ahead and refresh your browser. You can also restore windows by using the button at the bottom of your screen, and the size of each of the windows are adjustable, and you can kind of move them around your screen as well. This is an interactive event, and we welcome all of your questions. So if you want to go ahead and submit one, just type it into the Q&A below the slide window and click submit. And please include your first name and your city when asking the questions, and the moderators like myself will make sure to try and get to them. We'll also be taking some live polling questions. My favorite part, you're going to see the questions pop up on your screen as we're talking. So go ahead, take a moment and register your responses. And of course, go ahead on social media. You can get us on Twitter at #BloombergInvest to continue all of that conversation. And to help set us up here for all of today's conversations, I'd like to welcome Andy Blocker, the head of U.S. Government Affairs for Invesco U.S.
Good afternoon, everyone, and welcome to Day 2 of Bloomberg Invest, weathering market turbulence in the age of COVID-19. My name is Andy Blocker, and I am head of U.S. Government Affairs for Invesco, and I'm excited to be with you here today. Yesterday's event featured some fantastic speakers, including our very own Christina Hooper, bringing their perspectives on an economic recovery and where it's headed. In today's Setting the Stage, I'll be delving into the topic of a new world order and giving you our perspective on the U.S. government's response to the pandemic. In the onslaught of COVID-19 outbreak in the U.S., the government has responded with unprecedented speed, scale, and size. Both regulators and legislators recognized that the health crisis was quickly evolving into an economic crisis that needed to be mitigated, and a potential financial crisis that would need to be prevented. Otherwise, there would be no chance of a quick recovery on the other side of the health crisis. As we have illustrated for you, the federal government took more action in the first 2 months of this crisis than it did in the first 9 months last time around. Congress, which normally takes forever to do anything, actually worked at warp speed to get money into the hands of individuals, businesses, and healthcare workers, spending nearly $3 trillion already. The Treasury and Federal Reserve response took some of the playbook from the 2008 crisis, but also added some new plays, given that the early days of this crisis were liquidity and not credit driven. We have already seen the wisdom of this quick action response in recent signs of market recovery, but we are not out of the woods yet. We'll still need fiscal and monetary support for market liquidity, as well as a global resolve to step in and take quick, decisive action if there's a second wave of COVID-19. How far will governments and central banks need to go in order to mitigate the growing socio-economic impacts of this pandemic? What will be the implications of our deepening national deficits? How are we going to pay for it all? And who will shoulder the biggest burden in society? To answer these questions and more, Bloomberg has a talented lineup of panelists and speakers here today to explore this new world order in the age of COVID-19. Thank you for joining us, and I hope to see you all back here tomorrow as Ryan McCormick, our Invesco QQQ ETF strategist, will open up the day's discussion on putting money to work now.
All right, Andy, thank you so very much. So to help us set the stage even further for the rest of the day, I want to welcome in Bloomberg Editor-in-Chief John Migglethwaite and our first guest, Manny Roman. He's the CEO of Pimco. Gentlemen, welcome. John, I'll hand it over to you.
Alex, thank you. Thank you very much for that. Yes, we have Manny Roman, the CEO of Pimco. Most of you know well, Pimco manages altogether $1.8 trillion compared to the $1.5 trillion that Manny had when he started this job. Manny, welcome. Very nice to see you again.
Nice to see you, John.
Let's begin with the economy. You had a rather nice economic outlook quite recently, earlier in June, where the long climb, and you quoted the Richmond Fed President Thomas Barkin, where the economy rode the elevator down, but will have to climb the stairs back up. Is that the way you look at the recovery at the moment, that it's going to take longer and not be as rapid as some people hope?
It's correct. And I think there's a lot of things we know and there's a lot of things we don't know. But we expect real GDP to come back to the 2019 level by the end of 2021. And so there is going to be a lot of repair to be done in the system. There are sectors where the degree of predictability is very high in terms of what may happen. There are other sectors, retail, oil and gas, leisure, gaming, where there's a lot of things we don't know. As much as I would like to tell you that we can predict consumer behavior and how people are going to use anything from airlines to movie theater, we just don't know. And so when I think of the next 12 months, the error rate has to be much higher in terms of prediction.
Just quickly coming back on that, you said there were some areas where you did feel fairly confident. What would be the areas where you think you can predict, you sort of think you know what's going to happen?
Oh, I think the tech sector tells you everything you need to know about what has been predictable. And if I think back in the situation we were on March 15 and 16, if you had told us that the NASDAQ is nearly up 10% on the year, I would have been shocked. And so the recovery of the stock market has been nothing short of extraordinary. And tech companies have done remarkably well and seems to be, for the most part, totally unaffected by recent events.
But do you think those valuations are justified? I mean, surely you'd use the word surprising. That would sound as if you don't think that tech stock should be quite that high again.
Well, I'm hardly an expert on tech stock, but let's talk about credit for 1 second. I think that we've seen an enormous amount of issuance in the credit space from the end of March to today. And we have bridged the liquidity gap. Then there is going to be a long cycle where firms will need to think about solvency and their own businesses and what they can achieve. And if we know anything from history, we know it's a long cycle. It's a cycle where there'll be repair to be done and where some sectors are going to be profoundly affected and will need restructuring. Just think of the airline sector. When are we going to see each other in the flesh, John? And I don't know that. I don't know whether it's 2 weeks away or whether it's 6 months away. Part of it is also the virus, of course, where irrespective of how much work we've done in terms of understanding the risk and keeping our people safe, there's also things we don't know. And as you see cases ticking up in 26 of the states in America, there's just a lot of unknown in terms of people's behavior and what people are willing to do and not.
You see the best sort of risk return balance in that. At the moment, you have the Fed buying everything and supporting the markets. Where do you see the best return, given what you've just said about credit? You said that you're worried about that.
Well, I would just point out one thing, which I think is interesting. So if you look at the US cycles, distress is a long cycle, and the ability to deploy capital to restructuring situation is actually the opportunity to deliver outsized returns. It takes time. You don't have to hurry, but it's something that we're focusing on. And if there are opportunity to buy cheap businesses and cheap credit because of all the factors that we just mentioned, and the ability to put them in the correct fund structure with the correct liquidity, I think the industry will deliver outsized returns. And you've seen that for the first time, I would say, in the S&L crisis in 1991, then you saw that again in the Asian crisis in 97, 98, and you saw that in the tech and telco unwinding in 2001 and 2002. And then you saw obviously a lot in 2000 and 2009, and hopefully Pimco will thrive out of these markets and find plenty of opportunities to invest money.
Pimco is one of the famous winners from what happened in 2008 and 2009. Is there a particular area that you think will work for you in the same way as it did then? Then you avoided subprime and then you bought very well afterwards. Is there something that you particularly want to focus on this time?
I think we bought very well, and all credit to Dan Iverson at the time, and I think there were a lot of sleepless nights. So I think one has to be incredibly humble in terms of where we go forward. But I think that there'll be plenty of opportunity in the sectors that I mentioned, which are being challenged, to buy cheap assets, and also for most of what we do to avoid risky sectors and actually be defensive in terms of making sure that we don't own things that break. But there are sectors that we feel quite positive. Think, for example, of the housing market. We think housing is in pretty good shape. So the whole mortgage market, if it provides opportunity, is actually pretty steady. We think that housing in the US doesn't have enough supply, and that house prices, give or take, are reasonably stable, given what we know.
Can I ask you about a particular thing, which is the role of central banks? There's a very good article in Foreign Affairs by our mutual friend Sebastian Mallaby called The Age of Magical Money. And what it points out is that after the last financial crisis, the central bank stepped in and printed a vast amount of money. I think it was up to about $15 trillion. This time, they're already close to $10 trillion, and we've barely been through a year as opposed to a decade. How much does that impact your thinking? Surely at some time people have got to unwrap that.
Well, it of course impacts. I mean, it's a very good question. It's impacting us a lot, and we've seen what the ECB has done and how it has neutralized the risk of various countries. If we had this conversation 15 years ago, and we would have tried, you and I, to predict the spreads of Italian government bond, we would not have come remotely close to where they are today. And the other example.
Can I come back at you? Can I come back at you about Italy? Because by coincidence, I was going to pry you on that. You look at Italy. Italy has got vast amounts of debt against GDP, well over 100%, 130%. It has got some problems in the financial system, and yet it is trading at minuscule spreads, not just above German bonds, but above zero. Does that make sense to you?
Well, it makes sense in a mutualization system where the ECB is essentially buying a lot of the bonds and driving the price down. And it's no surprise. And I think that you can think of the ECB as a way to transfer credit risk from the best credit, in that case, Germany and the Netherlands, to weaker credit, and essentially having the ability to borrow and the ability to buy assets to level which are not equilibrium level, but level which are driven by a lot of purchase. And the one thing I would say is, for example, we think that the Italian banking sector is in good shape. So there are things in Italy which are working the right way. There's an industrial sector that will need to recover from post-COVID situation, but has a lot of good companies in the north of Italy and should be a very good exporter. So there are things working in Italy also. So I don't want to give you a bleak picture of what I think the Italian situation is, and hopefully there'll be more supply side reform in terms of competitiveness and in terms of company being able to grow the business.
In America, to what extent do you feel as if you're betting against the Fed in a strange way? The Fed is sitting there and underwriting so much. Does that make it difficult for someone who is an active fund manager? You're not just buying an index.
So we have this saying, John, we say don't bet against the Fed. And as far as we can tell, the Fed hasn't bought much. The Fed has signaled a total commitment to step in if need be. And you got to give them real credit, because the world looks like a very different place for March 17. And they acted very swiftly, and we needed it. And maybe the total crisis of liquidity we saw in the first 2 weeks of March was due to the fact that people were home. But I also think that it was due to an enormous amount of stress in the system, and something that no one had ever been confronted to, except for our colleagues working in Asia through the swine and the pig flu. And to much of their credit, they acted quite swiftly. How much they buy at the end, you can make a very decent argument that the signaling is actually more important than the actual amount that they buy. But once again, I don't want to understate the amount of restructuring that will need to happen in all of the various industry in terms of sizing up the business, sizing up leverage ratio, figuring out how much stock they can buy back, figuring out the headcount, figuring out outsourcing. I don't need to tell you, you will know that better than me, but we're going to be in the next 6 months in an election campaign. There'll be a lot of noise about China. So outsourcing is also going to be a big issue. We may see some inflation down the line. There's a lot of variables that come into the picture.
When do you see inflation coming back? Does that come back just purely because there's been so much money either pumped into the system or implied, and the fact that asset prices are so high?
I think it's the labor market where you see at some point in time some inflation. It's of course linked to commodity, but I think Joachim Fels, who's a head economist, sees inflation coming back slowly to the 2.3, 2.4 level over the next couple of years. And I think that the days of the inflation that we grew up with are gone. So I don't want to sound anything but measure in terms of what we say about inflation, but it's something that we'll have to look at, and we don't think the Fed is going to raise rates for a very long time. And so the most likely scenario.
What is the trigger? What is the trigger where you might see what numbers would you look for on inflation? What kind of early indicators would you look for?
I think it would be a continuing number of data points where you would see inflation coming back. And the Fed has learned its lesson from hiking too fast in 2005 and 2008 and 18. The Fed would not be keen to create a temper tantrum. And we think they would be quite measured in terms of what they do. They would need to see real sign of inflation before they do anything.
We talked a great deal about the Fed and central banks, but governments have also been pumping money into the system. There's been a vast sort of surplus. How do you think that unwinds? Do you think that we're living in an age where governments are just going to borrow more money? Or do you think that this is something where there has to be a kind of reckoning?
I think for the foreseeable future, you're going to see government with big balance sheet. One of the example that we can think about is the Japanese example, where you have a very high leverage ratio at the government level, and where the government owns 50% of the JGB in circulation, and essentially rates which are equal to zero. And if you look at the Japanese example, it's certainly not the example you want, and it's certainly not the outcome that you want to see happen. So fiscal stimulus will be very important, and finding other solution than monetary practices.
Do you see this as a time when reform will come to government in the West?
You hope so. You hope so that Congress can think about the issues. I think the issue in terms of structural reform, tax code, mobility, all of these things really matter. And it's true for the US, it's of course true for Europe. And the competitiveness of Europe over the long run, and the fact that in a global market, we need to have European companies being competitive, which is not a given. And I think that will be addressed by supply side reform, not by anything else. So I think there's a view to say that monetary theory is great, but it's only part of the equation, and that there are other structural reform which will need to happen that in a global market one needs to do.
I know you study history a lot, Manny. If you look at history at the moment, you see the performance of what's happened in Asia in terms of the response to the coronavirus, and you look at the West and you see the numbers of mortality, the difference between what's happened in the United States and certainly Britain, where numbers, 500, 400, 300 in America, 500, 600 in Britain of people dying per million. And then the numbers in Asia, places like South Korea and Taiwan, being as low as sort of 7 or 8. So many multiples better. Do you think that there has been a change in the way that you look at governments, that you now think of Asia as being somewhere which is better run?
Well, I don't know whether better is the term, but what you've seen is much better outcome in Asia in terms of result. And you can look at the US as a compact, and the compact was the way the US was created, a series of states getting together and signing the union. And you see the difference of opinion in terms of what the right strategy is and what's the right of the people in terms of COVID and the ability to go to work and their own safety. And I think you see very different decision. The people of Singapore are happy to have a central planner make health decision, which may actually impact the ability to go and take a walk in the street. The French people had to deal with the police checking a piece of paper explaining why they had to go to the supermarket. I think those practices in America would be much more difficult to enforce or to have people accept it. And I think you can see that as different views on what a contract between citizens and between the state can be. And one is not better than the other. It's just very different rights in terms of what you think the state should give you versus what your own personal liberties are. And you see that all the time in terms of privacy issues with social media, something that you intimately involved with. What does the state know and what does the state should know? And whether technology is a way also to help people dealing with COVID. I have no issue having Google know at every possible point in time where I am and whom I'm with, but I think you can make a reasonable argument against this, and that's the tension, I think.
In terms of running Pimco, you talked about people not changing their ways. You look at some people, CalPERS has come out talking about many more people working from home. You have UBS, I think this morning, saying a third of their workforce will work from home. How do you see Pimco being changed by what's happened in the virus?
Well, thank you for asking this. I think there are changes, and I think that there will be things which will remain the same. I think of our primary duty is actually to deliver returns to investors. And for the investment side of Pimco, I think that we will need most people to be back in the office with more distancing, with more training floors, with having safety as a number one priority. But we joke with Dan Iverson. We say that markets are pretty much efficient, so it's always a challenge to deliver alpha, and we need all hands on deck. And that's going to be what we need to do over the foreseeable future. The speed will be quite different. So in Asia, we have 75% of the people back at work. As you said, the situation in Hong Kong and Singapore, and they had a very tough time, is fine. Europe will be at 50 in not too distant future. Newport Beach, where people can drive to work, and actually Southern California has been a good place to be, everything else being equal, is fine. I would have told you 2 weeks ago Texas was in pretty good shape, or we have a big office in Austin, but I look at the news flow like you, and I don't know whether Houston is only affected, and whether Austin is going to be also a problem, and whether young people are going to be in the street and socialize more, and that's a problem for us. So question mark on Texas. And New York is a problem because public transport is the way people go to work. We have plenty of people living in Brooklyn and in New Jersey. They need to come to work, and we're going to need to find a way for them to come back safely. And when that happens and how we get that done is not simple. And I think the magic bullet is obviously a vaccine, and the fact that people feel comfortable that they can come and work without feeling that them and their family are being threatened.
You mentioned this idea of trying to deliver alpha, to try to do better. Do you think that the dynamic between people who take and put their money into index funds, active and passive management, has that in any way been changed by what has happened with the virus?
Well, I think you saw things in March, which I didn't think were possible. I mean, you saw fixed income ETF trading at 8 to 10% discount of net asset value, and the liquidity shock, even on passive, was nothing like you had ever seen. And so I think the environment in terms of active management, broadly speaking, and this is obviously true for everybody, is quite rich. There's a lot of things to do. There's a lot of alpha to be picked up. There's also risk. And, it's going to be making sure you do bottom-up work. We have 75 credit analysts. They're going to need to do their job and make sure we buy the right bond. We have, as you know, a very big agency and non-agency platform in mortgages. We need to make sure we do our work properly. But it is a good environment. We went from sitting here in January thinking that 2020 was going to be on the boring side of things until you got to the election. And we had an enormous roller coaster. But roller coaster also means that there's a time to play offense and a time to buy cheap assets. And I think that's where we are. So it's going to be a matter of navigating this. Sorry, John.
Sorry. So I was going to say, can I ask you one last thing about Pimco itself? When you were back at Man, you were not afraid of doing sort of big mergers and acquisitions. Now you're at Pimco. Pimco's tended to do slightly smaller ones. If you have an industry that's changing for the reasons you've just said, is it going to be, do you see a period of consolidation in the fund management industry? And are you interested in buying?
So we're not, and I think we've been very clear, and I've been very clear about the fact that all organic growth is going to be, all growth, will be organic. And yes, we may make small acquisition, but the reality is Pimco will not change. And I think for us, focus is very essential. We're not trying to be all things to all people, and we have a strong culture. We have a strong investment culture, and it's much easier for us to add people than to buy people. Now, I can tell you, tech and the size of the investment in tech is enormous. And I think that you will see smaller asset manager thinking twice about whether they want to remain independent and whether there are synergies to be achieved by merging down the line. Practically speaking, I think when people talk on Zoom, it is not easy to do merger. So until we can come back to face-to-face meeting, I don't think you'll see many mergers, broadly speaking, because they're just hard to do. I think at some point in time you need to break bread and look at each other in the eyes and say, this is something we want to do. This is the right thing to do. And it's harder unless you know the person forever to do by Zoom. I think that's one of the few things that modern media has not been able to deliver.
One last quick question to ask you about is globalization. You are a composite global figure. You're a Frenchman living in California, and all your life you have followed these markets all the way around the world. Do you now see them splitting up much more?
I think there's an issue with China in terms of the next 6 months. And John, we first met a long time ago when you predicted Obama becoming the US president. And I remember we all laughed at you, but you were 100% right. And we're going to have an election.
A rare exception to the rule, but yes.
A rare exception. But we're going to have an election where I think globalization is going to be a big debate. And yes, it may be debated in a way that neither you nor I will like in terms of the detail, but China will be a big point of contention. And in the Trump-Biden election, I'm sure that there will be a big debate. Or political analyst Libby Cantrell often says it's 6 states which will decide the election, and these 6 states all have a view, rightly or wrongly, on globalization and what it means for jobs and what it means for the economy, and that certainly will be a divide. I grew up in a world where I thought that globalization was always a good thing, but I fully realize that if it doesn't come with retraining of lower skilled jobs, it creates deep inequality. And that's what you saw in the labor market in the US in terms of skilled workers versus unskilled workers. And the competitiveness of the labor market in terms of people who can move and do new jobs and people who cannot. And I think that explains a lot of what we've seen over the past few years.
Do you think the choice in the election is going to be between a tough policy on China and an even tougher policy?
I don't know that. I think that if you talk to companies, outsourcing has had many benefits. I mean, we also have to recognize how beneficial NAFTA has been. We have to realize that many companies have become much more productive because of the outsourcing to China. I think many companies will say that they want to diversify away and have a supply chain that is more robust, if nothing else because of COVID. I mean, many companies couldn't get the import done in March and April because China wasn't exporting. So you may see more outsourcing done in other countries, but it will certainly be a highly contentious debate. We'll see how it unfolds, and obviously it will have implications for us, and we'll adjust our portfolio accordingly.
Well, we will look forward to discussing that with you. Manny Roman, CEO of Pimco, thank you very much for speaking
John,
to Bloomberg.
thank you for having me.
And to the Invest Global Conference. I'm going to hand back to Alex Steele. Alex.
Thank you so much, Manny. That was a really interesting conversation. And based on that, we want to get your thoughts. This is the first poll of the day. So take a minute to answer this one. The question is, what shape will the economy take, the economic recovery take? You can do U-shape, V-shape, W-shape, or a tick mark shape. I don't think I've heard a tick mark shape before, but those are your 4 choices. If you can sort of answer, that'd be a really great setup for this next portion of the day. And while you make your choices, I'm going to bring in the next guest, which is Kewsong Lee. He's co-CEO of the Carlyle Group. Q, it's good to see you.
How are you? How are you, Alex? Good
Hi,
to see you.
thanks for joining. Great. So we're taking a look at the poll here. So as we settle out, it looks like the majority of respondents expect a W-shape, 47%, a W-shape recovery. So Q, do you agree with that? And if that's the case, like, what does that mean to someone who has to put like billions of dollars worth into the market in some capacity?
Well, look, there's so much we don't know yet. I mean, there's a sharp bounce back because I do think the worst is over in terms of April being the low point. But a sharp bounce back does not by any stretch mean a V-shaped recovery. I mean, what we're seeing, we have such an enormous global platform. What we're seeing in China, for instance, and that's probably the best example of something that's close to a V-shaped recovery. Given consumer skittishness, given some of the factors involved in terms of changed behavior, et cetera, we're seeing the economy come back to about a 90% level organically. In the U.S., I think it's going to be a little bit more challenging. The restart is going in fits and starts. There's a lot we still don't know. There's tremendous issues in terms of how we contact trace and mitigate other occurrences of the virus potentially in the future, liability issues that have to be worked out. And of course, there's the possibility of a jobless recovery. So if I had to say it right now, I mean, I really don't know, but I certainly don't believe it's going to be V-shaped. I think the bottom of it looks like it's going to be V-shaped, which people will look hopeful to, but then I do think it's going to struggle moving on. And I don't suspect we get to pre-COVID levels for a couple years, just given the nature of the recovery that's going to be difficult.
Oh, that's interesting. Does that mean that in China, if you're back to like 90%, you expect that to then go down a little bit before we get another recovery, or are they on like the last line of the W?
Right. It seems to have plateaued a bit, but I think the most important thing to appreciate, Alex, is that in China, if I were to ask you how much money was spent by the government to get that recovery going, it's virtually nothing. So they managed their recovery on a very organic basis. Whereas if you look at Europe and the United States, tremendous amount of fiscal stimulus and sustenance was required, injecting it into the economy. So they have a lot of ammunition to go. And you also have to understand China's, the export portion of China's economy has remarkably shrunk over the past 10 years, something like 40% down to closer to 20%. And so given that, China's got a lot more going for it than you'd think, and there may even be a chance that it does not hit a recession this year. Unfortunately, I think the United States, we're going to have a little bit more fits and starts. I do think the resiliency of our economy is such that we'll power through this, but it's not going to be a classic V shape. I would be more in the kind of check mark shape with some squiggly lines along the way, as the second part of that V is a little bit lesser dramatically sloped and more jagged.
You're adding squiggly lines now, because that's like another thing. It's like another checkpoint we have to make. So does that mean from an investment perspective that you'd rather be investing it's a better chance to put money in China than into distress in the US or in Europe, for example?
Well, I think, when you have a platform as large as we are all over the world, all asset classes, all these different investment strategies, the question is not, are you investing or not? Because we're always investing. We're active, but it's being selective and about understanding where you want to put your money to work, because there's a difference between investing aggressively and investing wisely. We're in the long-term business where we have balanced perspective, and that's what our investors pay us for. And we've been very selective about being aggressive in the credit asset class, particularly in the opportunistic strategies. We really like healthcare and tech, particularly in parts of the Far East. And so we have been deploying not as aggressively as as some may say, but it's been pretty darn active. But investing is not only just putting money to work, it's also trying to understand how to exit appropriately. And we have been pretty successful even during these times with pandemic with respect to IPOs, for instance, ZoomInfo or One Medical. Both successful instances of IPOs during troubled times, but also M&A sales in Japan and in other parts of the world. So we're always selling, we're always buying, but it's about being selective and targeted and investing wisely with a long-term perspective, which is what we're trying to pursue.
So, and Manny and John kind of touched on this in their panel, is the decoupling kind of everywhere. And I say decoupling of the US and China, but it could also be the EU and China. It could be the US and the EU. How does someone like you, who's looking for opportunities across the board, look at that conversation?
Right. It's funny, Alex, and I'll bring this into it in my answer. If I were to ask you or the audience to close their eyes and go back to pre-COVID, and I know it seems so far away, but if you were to go back,
I don't remember that, Q. I can't do it. It's too hard.
I long for that. If you go back to the fall of last year and close your eyes, and you were speaking to Manny or me or others, the trends we'd be talking about would be low global growth, low rates, disinflation, no inflation, abundant energy, the impact of disruption of technology, polarization, nationalism, populism. You'd also be talking about trade tensions and decoupling. And if now all of a sudden you open up your eyes and you're in a kind of in the crisis moment, none of those trends have changed. None of them have changed. It's still low global growth, low yields for probably a lot longer than we'd imagine, disinflation, abundant energy. If you were watching CNN or Fox before the crisis, you're still watching CNN or Fox during the middle of this crisis. So that goes to the whole decoupling and the tensions that we're seeing between the U.S. and China. I think this is, clearly an issue for all of us with respect to, a major paradigm. The globalist framework is at risk and is changing. I do think this is something which is not going to be for the better. We're all better off if the two largest economies in the world, these two large ecosystems, can figure out how to constructively engage to the mutual benefit of both and the world. But clearly, there are issues right now with respect to that relationship that our leaders need to resolve moving forward.
Then, in terms of, say, investments here in the U.S. to capitalize off of that, where are the opportunities? I mean, if we're going to reshore some manufacturing or building, is it warehousing, is it inventory? Like, where are the good opportunities for you?
Well, in terms of sectors we like, obviously, it's simple to say healthcare and technology. If you're looking for growth longer term, you can't help but to think there aren't great opportunities in the Far East. But I like to talk about the 5 C's, the cloud, e-commerce, cyber, cashless, and collaboration. And those are all trends that are picking up. And irrespective of what industry you're in, if you can pick up on any of those trends, I think you've got an interesting business model. What we've noticed during this crisis is that many trends have accelerated, and businesses' ability to be disruptive has actually increased. And so a lot of the opportunities we're looking at right now tend to be more growth oriented. The traditional late stage, very large buyout private equity deal is something which I think is going to be a little bit more slow in coming as we all try to find our sea legs with respect to the future earnings and as it relates to kind of our assumptions as to where all this is going. But growth investments in some of the sectors I've identified and some of the themes that I've just talked about are all very interesting and compelling.
And this is for an audience member, and this is actually a great question. I was going to try and go there. Was private equity marks in Q1 were very tough for most major firms. Has the crisis adjusted underwriting for new deals, and if so, how? And it's a good question too. Like who has more control? What do covenants look like? How have contracts changed, etc.?
Yeah, buyers mark to market faster than sellers, and so I think just transacting in terms of the traditional private equity deals are just going to get harder, which is why I think you're seeing volumes fall. With respect to investment return requirements, it all really depends. I mean, for very, very stable, safe companies, resilient companies, in many instances, we might be willing to pay even more for those types of companies now than we otherwise would have, because it's just been proven that they can get through a crisis like this, navigate through, and continue to grow. Those are very, very valuable companies. What I'm seeing happening is almost a bifurcation into the haves and the have-nots. It very well may be that certain types of companies and business models actually command higher multiples, where we're willing to pay higher prices, maybe accept lower rates of return for those companies versus the have-nots. In a world Alex, where rates could be zero for a long period of time, I think the real interesting question for investors to have to answer is going to be, well, what's the right risk premium and what are the right return expectations for various different asset classes? If you think that rates are going to be zero for a long period of time, you can't help but to think there's going to be some type of compression over the longer term with respect to returns. As it relates to Carlyle and what we're looking to do, it's all about the CEOs finding the right companies in the right sectors. And we feel that if we can do that well and partner with them over a long-term time frame to build their businesses, the returns will work out just fine.
Another audience question here, talking about China, we touched on it briefly, but if we kind of walk forward a U.S.-China trade or non-trade deal, if we go the route of decoupling, if a trade deal doesn't work out, particularly as we get much more stress towards the election,
right?
Does that create more or less opportunity for you here or in China?
Given our footprint, no matter what happens, I think there's going to be opportunity for Carlyle as it relates to change and the environment as disruption occurs. Obviously, investors are able to find opportunities when that happens. But taking a step back, I really hope that doesn't happen. I think it's really important for both sides to make phase one work. It's almost symbolic at this point that both countries have the will to enable phase one to happen. I do think the rhetoric needs to come down from both sides. In particular, and this was just touched on in the last interview, there's this notion that we need to 100% onshore. And I think the argument needs to be much more, the narrative needs to be much more about resilient supply chains. And resilient supply chains do incorporate an amount of onshoring, but for American corporations to be truly competitive in this global marketplace, we need global supply chains. If you talk to a lot of CEOs, that's exactly what they appreciate and understand. And so there's a lot of complications as it relates to the whole U.S.-China, the trade deal, and the potential impact of decoupling. But I just want to say, stepping back, I think it's really important that phase one, that part of the agreement gets fulfilled, and that we carefully think through the right narrative as it relates to the resilience of supply chains moving forward.
Yeah, so yes, but please don't let it get to that, is what you're saying. The other thing is, if you talk to any private equity person or really any major investor in like 6 months ago pre-COVID, all the talk was about ESG, and it was really primarily focused on the E and a lot of environmental investments and impact investing, et cetera. I feel that now the S has become in so many ways more important as we come out of this. I'm interested in what Carlyle is doing and thinking in terms of investing in ESG, but also how you rank the companies that you're already invested in to see if they're meeting the criteria that you want to stand by.
Sure. As far as Carlyle is concerned, the E, the S, and the G, they're all important. It's all about having maximum impact. And so for us, the whole notion of impact it's not a product. We think about trying to have impact in every single company and every single investment we make by simply having a philosophy that our job is to make businesses better across the board, from revenues, from costs, from capital efficiency, but also in terms of diversity at their boards, in terms of what they're doing with respect to climate change and sustainability practices. So for instance, we have one company where we've put in place a capital structure, a bank financing structure, whereby if that company improves its ability to be more sustainable with respect to some of its manufacturing processes, the cost of financing actually comes down. So the banks have motivated us and motivated this company to continually improve on its sustainability practices. And if that happens, the cost of its debt actually falls. So there are lots of different ways that we are trying to push our way of thinking into our investing processes. But it's an integrated mindset. It's not a product. It's a mindset of just appreciating that our job is to have positive impact. Our job is to drive a total value creation. And the only way to do that is to adopt a mentality of let's make businesses better. And it's all aspects of ESG that's required to do that.
So in a rudimentary sense, if you were already invested in a company that had no minorities on their board, would you now go to them and say, you got to get one on your board in 3 months or else I'm dumping my investment, even if the company did have good free cash flow and was a solid company?
Sure. So, Alex, this is a really important topic and something that we've actually been working on for many, many, many years. A handful of years ago, we implemented a policy that in all the companies we control, we wanted at least 2 directors with diverse backgrounds on their board. And, we made tremendous progress in the US. Close to 90% of our controlled companies now have at least 2 directors with diverse background. And we are now in the process of upping that even higher. And so this is not something we've just started or we're going to do in the future. We've already been doing this, but we have more work to do to continue to drive improvement in this area. And let me just address why this is so important for us. Diversity and diversity of background, diversity of experiences is exceptionally important in a business like ours because we are in the judgment business. We're in the decision-making business. And in today's complex world, you want as many different viewpoints, perspectives, and you want the benefit of those diverse experience and insights helping you make those judgments. And our experience is having diverse boards, having diverse leadership really enables us to make better decisions. And if we can do that, the superior judgment results in better investment results, which obviously inures to the benefit of our clients. So this is a really important topic for us, not because it's a statistic or it's the theme of the day. It's at the very essence and core of what we do, which is to make great investment decisions on behalf of our clients.
So how active would you be in that? Like, I get that you already screened all your investments past certain criteria. If you up the criteria, how active would you be in then divesting those businesses that didn't work for you on those metrics? Like, where we're really going to find change is through the pressure from the people with money.
Sure. So we no deal can get done at Carlyle without, from the very beginning, ESG screens, and that's part of our whole investment process. In fact, no deal can even come to the investment committee at Carlyle without a thorough check on all of these topics. So it's integrated from the very beginning of our investment process. And it's not, it's an entire team, an entire function we have globally at Carlyle. Furthermore, once the deal is made, we track and monitor how these companies are doing against these metrics, and then we report to them, to our limited partners. So, it sounds so theoretically elegant. It's exceptionally hard to do practically around the world. In Europe, I think we're more ahead than in other regions of the world, but we are certainly trying our best to figure out how we import and export our best practices across the firm. Because it's important. It like I said, this helps to drive our investment return and our ability to drive value. But it has to be from the very beginning all the way to the end. It can't be something that you just all of a sudden say, "Oh, okay, we got to check that box. Let me just go get that analysis done." That's just not the way we think about it at Carlyle.
Okay, sure. I'm at home, and are you at home or are you in the office?
I'm now at home. Yes, I am.
You're at home. So can you tell me what Carlyle's doing at bringing people back to work? I mean, I know we want everyone to be safe, but is there a world where like half your staff works from home all the time?
Right. So really quickly, we have 32 offices. We have our Far East offices are up and running. India is shut right now. Continental Europe is up and running. London, New York, and DC are still closed. We're targeting a September date for a reopen with those offices. This has been very challenging, but I'm really proud of how Carlyle has come together. We have adapted to this remote work environment incredibly well. Just so you know, Alex, I tracked this over 120,000 Zoom calls just in the past 3 months, and we haven't missed a beat. My view, however, is that you're all better off, everybody in the office. You're almost better off everybody not in the office. And the worst is if you have kind of a half and half hybrid where some people are in and some people are out. And so obviously we're focused intensely on the safety and the well-being of our employees. We're carefully thinking through what the ramifications are of how we get them to work. But, I'd be remiss if I didn't say, Alex, that I think while video technology and video collaboration has enabled all of us to keep our businesses going, it's enabled us to sustain what we do. I do think this erodes company culture, and this erodes a company's ability to be effective over the longer term. So the leadership team at Carlyle is very focused on, as soon as it's safe, making sure we can get all of our employees back so that we can continue to work together and really develop the relationships internally that's required to keep our culture vibrant, so that we can continue to compete while moving forward.
1,200 Zoom calls or something? That's insane. That's not good for anyone's health.
100, you know as well as I do, it just wears on you, right? These calls just wear on you over time.
Totally. All right, Q, thanks a lot. It was really great to chat with you. I appreciate all the insight. Kewsong Lee joining us from the Carlyle Group. And up next, we're going to hear from a few of our Bloomberg intelligence analysts now on what they are seeing in the global rates and credit market.
The coronavirus pandemic is enlarging sovereign debt loads and fueling local demand for dollars, aggregating fiscal imbalances and exposing emerging market investors to greater risk. Good afternoon. My name is Damian Sassower. I'm the Chief Emerging Market Fixed Income Strategist for Bloomberg Intelligence. And for the purpose of this presentation, I think it's instructive to see just how far we've come since mid-March, when EM dollar and local currency investors were grappling with losses on the order of 13% and 15% respectively. In slide 1, we break down total returns for the EM US dollar aggregate bond index into its constituent parts. And what you find is that the positive returns from carry, which is coupon income, and duration, which are movements attributed to shifts in the US yield curve, fail to overcome the losses we're witnessing from spread-related factors. And so Latin America obviously is weighing from a spread perspective on most returns year to date, with Brazil standing out, Mexico standing out, and of course, Argentina down 19% year to date, standing out in the eyes of investors. Slide 2, we do the same thing for EM local currency bonds. And what we find here is that, again, the returns attributed to carry, which is coupon income, and duration, which is attributed to movements in the local currency bond curves for each of the 20 countries in the index, fail to overcome the negative performance we've seen from FX, from currency losses. And so here, what you find is that it's the high beta currency crosses, specifically those in Brazil, Mexico, Russia, South Africa, that have really weighed on returns year to date. And with the index down roughly 4% today relative to down 50% back in mid-March, we can really see just how far we've come on the currency side and whether or not those gains are going to hold for investors. So what is driving some of the gains we've seen across emerging markets? Well, it's the extraordinary central bank stimulus, both across developed markets, but more importantly, across emerging markets, which are really pulling yields down and driving up the valuations of the underlying debt. And so we've seen roughly or more than 5,000 basis points in central bank rate cuts since 2018 across the whole of emerging markets. That's unprecedented, never before seen. And what that's doing is, while it is fueling duration gains, we question just how much capacity many of these central banks have to continue to cut rates going forward. Shifting to slide 4, what we've seen is that with all these rate cuts that we witnessed across both developed and emerging markets, the average yield to worst for the Bloomberg Barclays global aggregate has fallen from 2% at the end of 2018 to 1% today, or just under it, call it 99 basis points. So a rough halving of the yield or the income that investors can expect from investing in a diversified bond portfolio of investment grade debt. And so while that has pulled down EM local currency yields as well on the order of 210 basis points over the period, We do think we're going to see a bit of a rotation, and we are beginning to see that into some of the high-yielding emerging markets that are within that index, specifically Indonesia, Mexico, and Russia. Those three countries have average yield to worst in excess of 4%. And so while we do expect to see that shift continue, there are still risks prevalent across the EM marketplace, and the concerns that are growing amongst the eyes of investors as we approach the zero lower bound in the US are not going away anytime soon. Thank you for your time.
Hi, I'm Stephen Chu, the Asia FX and Rate Strategist at Bloomberg Intelligence. We will discuss why we are positive about the Chinese yuan and the Chinese government bonds in the post-COVID world. Firstly, with the Fed printing trillions of dollars to battle the pandemic crisis, we believe by now the dollar credit or dollar equities may deem to be less appealing to some foreign investors. And the search for yield behavior may render capital to eventually flow back to the EM markets, especially EM Asia. Asia may be ahead of the rest of the world in virus containment and macro recovery, and their respective equities and bonds should have alert to the foreign investors, we believe. In fact, the Asia capital outflow momentum on a 90-day rolling basis has been slowing as inflows start coming back in recent weeks. Within Asia, one obvious destination will be the Chinese yuan assets, especially China bonds. China has less urgency to normalize monetary easing even in the post-COVID world, as the PBOC did refrain from bold rate cuts or triple R cuts earlier this year. At the moment, the 10-year China government bond yield is over 200 basis points above the US Treasury yield, and even 50 basis points above with a FX hedge basis. While other EM Asia bonds may offer higher yields, their currencies are more volatile and come with pricier FX hedging costs. Now, in fact, FX hedging may not be necessary as the yuan itself has long-term appreciation potential. With the US dollar facing a structural downtrend in the second half of the year due to the Fed's heavy printing, the yuan itself has headroom because its role as a reserve currency could thrive from here. Foreign investors, especially the central banks and sovereign wealth funds, may further diversify their research into the yuan and China bonds, we believe. Finally, China's bond curve might have bear flattened too much since May, according to our positioning analysis. Here we'll look at the heat map of Z scores of various spread buckets of the China bond curve, and we found that the spread with the 3-year as the front rate has bear flattened too much. In fact, the 3-year 10-year spread has flattened all the way from above 110 basis points, which by the way was the steepest since 2010, to below 50 basis points right now. The reason was that PBOC disappointed market with the lack of monetary easing over the last few weeks. But that makes sense because PBOC really didn't go for bold easing at the beginning of the crisis. So all being said, we think now could be a good window for boost steepening in the China bond curve again. And the bondholders may prefer to stay in shorter duration, in our view. Thank you. For more information, you can find us at Bloomberg Intelligence on Bloomberg.com.
Hello, welcome back to the Bloomberg Invest Global Conference, and thanks to our colleagues at Bloomberg Intelligence. I'm joined now by Carmen Reinhart, the recently appointed Chief Economist at the World Bank, of course a teacher of international finance at Kennedy School at Harvard, and most famous for being the co-author of This Time is Different, the best-selling book on a financial crisis. Welcome, Carmen.
Thank you.
I'd like to start with the cliched question, of course. Is this time different? And if so, what is the World Bank trying to achieve in getting the world back on track?
Well, so two very different questions. Is this time different? I think, Simon, we've spoken before. You know that since fairly early in the process, I've been highlighting the point that this indeed is different. This didn't originate in a financial excess in the 2008, 2009, and other varieties, but it has morphed into a major crisis. And one of the things that I've highlighted that is very different is that the policy response, the lockdowns, the distancing, the suspension of global travel of any shape or form is a very novel response to pandemics. Pandemics are old. I've likened and this is relevant to the World Bank response, I've likened the crisis more to the 30s than to the global financial crisis of 2008, 2009. And the reason for likening it more to the 30s, despite the fact that the macro policy response across countries has been very different from what we saw in the 30s, but the reason for making it more akin to the 30s is that this is truly a global financial crisis. 2008, 2009 was a crisis, a banking financial crisis in 11 advanced economies. The emerging markets were hit in 2008, 2009, but rebounded very sharply. China was growing double digits. Commodity markets were very strong. And this time, of course, if the advanced economies are seeing problems, it actually pales in comparison to some of the problems and challenges that the developing countries and emerging markets are seeing because they don't have safety nets, because they don't have the fiscal space to try to counter the effects of the lockdowns. And so, the issue of how do you support countries in which revenue has collapsed. If you rely on tourism, tourism has collapsed. If you rely on commodities, commodity price exports and volumes are down. So the World Bank and the IMF, the multilateral community in general, has been engaged in record lending, both in terms of the volume of lending and in terms of the number of countries that have accessed that lending. And one very important feature that distinguishes this lending wave, if you will, by the multilaterals, by the World Bank, by the IMF, is the speed with which it has been decided on, moved upon, and reached their destinations for countries to be enabled to counter all the very many dimensions of the adverse shock they're facing. Because, as I said, this crisis, the manifestations it has taken, it's not just a health crisis in some regions and some areas of sub-Saharan Africa. You're also facing food crises situations in cases in the Caribbean in which you have an overwhelming dependency on tourism. The situation is very different, but nonetheless very acute. So there's a diversity of very serious problems. And so the response is, up to the moment, has been based on providing the speediest relief.
And what more can be done now that speedy relief has been put in place?
What more can be done? Well, on May 1st, the G20 also agreed to an initiative that would suspend debt servicing for the poorest countries, the IDA countries. And the kind of savings potentially would be freed up resources that were being used to service the debt, to be used to support support the anti-COVID response. And so far, the participation has been predominantly an official one. That is to say, despite very early efforts, and our president, David Malpass, has been making repeated rounds to get the private sector on board. So far, the participation on the temporary suspension of debt servicing has been limited to the official creditors. But what more can be done? I think an important one is also some debt relief from the private creditors, which has yet not been forthcoming. Now, beyond that, what can be done is complicated, right? Because what we've seen in the U.S., what we've seen in Europe, and in some of the major central banks is undertake unprecedented policy actions to provide liquidity, to provide support to banks that have loans that have been compromised by the output collapse and the surge in unemployment, to provide support to high yield corporates. The international community doesn't have that kind of firepower. The IMF or the World Bank have that kind. Can't print dollars. You don't have the ability to act as forcefully as we've seen in the Federal Reserve. So I think going forward, revisiting the issue of expanding the capacity of multilaterals to continue to provide assistance, especially in a scenario where the COVID pandemic is not dealt with more definitively, i.e. a vaccine that is widely accessible globally. In that eventuality, that's an issue that's ahead of us.
And what's at stake here if the private sector doesn't join the relief efforts that the sovereign sector has? Is that a challenge to the recovery eventually?
Many things are at stake. There is the issue that, again, in the midst of what can be safely described as the worst global crisis we've had in at least almost a century. That in that kind of environment, countries are torn or between diverting resources to debt servicing versus using the resources to support social safety, both in the medical front and also support lost incomes. So there's that enormous tension.